Thank you so much for having me present today. I'm going to present a paper which is joint work with my colleague Laura Veldkamp. So let me jump right into the motivation for this paper. In this paper, we make a simple but very kind of big claim, which is that big data technologies are the industrialization of knowledge production. Now, what do we mean by that, and how do we go about trying to assess whether this statement is indeed correct? So let me start with an example. Imagine that we are before the Industrial Revolution and we have a blacksmith who had some capital, bought some tools, and utilizes his own human labor in order to produce some goods that then he sells in the market. Now imagine that I was to give a lot more capital to this blacksmith. Now, he could potentially hire some apprentices, scale up a little bit, but that type of business is not really efficient for scaling up. And so the marginal value of those additional dollars would not be so high, or at least it would not be as high as after the Industrial Revolution. Imagine now we have a factory and a factory owner and a new mode of production, a new technology. And now if I was to give all that more capital to the factory owner, it could much more easily scale up production and make more productive use of those additional dollars that potentially would have a higher marginal value. Okay, so now imagine this parallel. Think we are in the investment management industry, and I have an investment manager that has a data set of 100 variables, 1 million observations, and he utilizes this data in order to come up with some trading signals. And let's think that our investment manager is endowed with what we call old technology. Think regression for simplicity. Now imagine that I was to give a lot more data to this investment manager, 1 million variables and 50 million more observations. Definitely can do something more with that data, but it cannot plug it all into a regression. If regression analysis is the technology it has, the marginal value of all that additional data is not so high. Now, instead, imagine that I give all that additional data to an investment manager which is endowed with new big data technologies. Let's call those AI for simplicity. Well, now, if I give him all these additional data, he has a technology that can lever large data sets, find patterns, and draw more value from these additional data. And so to go back to our parallel, in this case, potentially, the marginal value of that additional data would be higher once it's in the hands of an investment manager, which is endowed with this new technology. So in that sense, we could think that these new big data technologies are changing the relative intensity of labor to data rather than labor to capital, as we're used to thinking about it for the Industrial Revolution, for instance, where data is a new form of capital. Now, if that is the case, and this is indeed a change of large proportion, that matters, and it matters a lot for many things we care about, like employment, labor income shares, firm size, competition, and so on, particularly because we think of these technologies as being general purpose technologies. Now, what's the challenge here? We're at the early stages of adoption, and definitely we cannot do such a large scale analysis to the whole economy. So what we do in this paper is that we focus on one industry, which is an early adopter and is clearly a knowledge industry, and we try to assess and quantify how much does the adoption of this new technology actually change the intensity of data to labor and the productivity of analyzing larger data sets. For those purposes, we focus on investment management, as it does have those two nice characteristics for us. Now, this one flow chart summarizes how we're thinking about this issue. How do we think about knowledge production, which is, in the case of our investment manager, is going from data to trading signals that then can be used to trade in the market? Well, we think of it as being kind of a two-stages process. First, I have raw and structured data. Think about it as Edgar filings that can be freely mined. Think about it purchasing data from external providers, so on and so forth. But this raw and structured data, all of us that do empirical analysis, we know that we cannot just buy a new data set and plug it into a regression or an AI model. We need to do some processing. We need to clean, structure the data, warehouse it. And that's all the more relevant when we're thinking about firms that are going to have to make investments into their data warehousing, cybersecurity, so on and so forth. So in order to have data, this capital D that we can actually process, we need to invest into our data stock. After we have this data, we have our database that we can draw from. That's when analysis happen. And here is where we think that this technological change is happening, at least in the perspective of how do I analyze the data. So you can analyze the data with the old technology, again, think regression for simplicity, or the new technology, again, think AI for simplicity. Now, how does this change in technology here affect this whole process? And it's important to think about it this way because, of course, if I have a technology that can analyze more data, I'm going to have an incentive to collect more of it and vice versa. So these two things need to be modeled in such a way that they fit into each other. So what we do is that we develop a simple model, we put some equations behind this flow chart, and we go to the data and try to estimate this model structurally. Having a structural approach is extremely important for what I just said now. Well, these two things are endogenous. If I have more data, I want to invest in being able to analyze it more efficiently. And if I have the technologies to efficiently analyze data, I have an incentive to collect more of it. And so having a structural approach to this problem turns out to be particularly relevant. Now, we model this system, and then we want to estimate it using real world data about the investment management industry. How do we go about it? We adopt a labor-based approach. That's one of the novelties of this paper. We basically measure how much firms are investing in their data stock, utilizing how much demand they're having for this data management labor. All this labor that you would think does data cleaning, structuring, warehousing, cybersecurity, so on and so forth. And we proxy for firms' investment in these new technologies by looking at their demand for labor that does analysis jobs that is skilled with the old or new technologies. We also utilize information from the Bureau of Labor Statistics to transform the demand for labor into actual stock of labor. In order to measure the income shares that are going to be very important to analyze this difference in productivity of these technologies, we're going to also need salary data, which is specific to these different job types, and we're going to have some crowdsourced data. And as I mentioned, we structurally estimate the parameters of this system. And our main object of interest is comparing the parameters that regulate these two different production functions for knowledge. Now, the main result, just as a quick anticipation, is that indeed we find that within this industry, in the time period of our analysis, AI has indeed significantly raised the productivity of analyzing larger data sets. Labor income shares fell from 18% to 13%, a 5% drop just within the 3 years of our estimation period, 2015 till 2018. And if we want to have some kind of like magnitude comparison, this is actually comparable to some of the lower estimates for the Industrial Revolution. So it's not a negligible change. We could think that this fall in income share, we need fewer labor for the amount of data in order to produce knowledge. We could think that that's actually decreasing how much labor we demand. And we find that actually that's not the case. The workers are getting a smaller percentage, but a smaller percentage of a larger pie. And so hiring has been increasing in this period, as well as, of course, the value of data has been increasing because we can do more with it. We've become more productive at utilizing it. Now, to give you a sense of what this work relates to, as I mentioned, we're going to utilize a labor approach in order to value intangible assets, data, and that's a contribution to this literature trying to utilize structural estimation to value intangibles. Also, that two-step process, we have raw data, we need to process it, and then we can analyze it and create signals. It's an important contribution to the information literature where usually we equate data and signals. Here we split those two and we say, well, how do we go from data to actual insight? And kind of we're like taking one step back from what we are used to seeing in all these information papers. And of course, because the subject matter is AI and we have this labor approach, we're going to have also something to say about the impact of AI on the labor market. Now, hopefully, all of that is already giving you a sense of what I'm doing. Now, let me give you just a bit more detail about the different parts of this paper. So first, let me start with the model. And this, as the title says, is a model for measurement. So the objective is to have a simple structure that we can estimate empirically, and we can get some estimates of those value of interest, which is this change in productivity. Now, As I said, we're going to have production functions for knowledge. These are going to be classic Cobb-Douglas production functions. And we're going to use the shorthand AI and old tech to refer to the new and the old technologies. Now, both of these production functions are going to have this capital D, this data stock for each firm I and each time T, which are going to be months in our estimation. The data stock is the same for both technologies, meaning I'm JP Morgan, I can have some AI analysts and some old tech analysts, and they're all going to draw from my database. So they're drawing from the same data, they're potentially doing different things with it. This capital L and small l is the amount of labor that I have. And these are actually two different variables. This is labor skilled with the new technology and labor skilled with the old technology. The parameter we're after are these alpha and gamma. This regulates the proportion of data to labor, and in a Cobb-Douglas setting, they're also going to regulate these labor income shares. And so we're really after trying to figure out what's the difference between alpha and gamma, and we really come agnostic at this question. We could find that they're not statistically different from each other, but if they are statistically different from each other and large, there is one way of thinking about this as being a transformative change. These CFP parameters that are time-specific or firm-specific, these are important in here because they're going to capture any other thing that we might think about that is time varying, that's not necessarily related with the technology itself. Think about, for instance, we're becoming better at using AI. It's not necessarily the technology's changed, but we're becoming more used to it. So this time varying parameter is going to be important. Or you might think that some firms are just better at adopting the technologies than others. These firm-based parameters are going to be important, and they're going to allow us to really only capture the intrinsic differences in the two technologies, in this difference between alpha and gamma. Now, that's the second step of that flow chart. The first part is that, well, I need to invest in my own data in order to make it utilizable and processable. So we don't think about raw data as being the input to these production functions, this capital D, but I need to invest in making it that. So what is the process for generating data? Well, the stock of data of firm I at time t plus 1 is just going to be however much data they had at time t, depreciated at some parameter delta, at some rate delta, plus however much new data my data management workers are able to add to my data set at time t. So this process is going to regulate this investment in data. So what do firms do? Well, firms are just trying to maximize the value they can extract from data. What are they going to choose? They're going to choose how much to invest in this data accumulation through their data management labor, and how much to invest in data analysis through their choices of this AI skill labor versus old tech skill labor. What does this value, how is it composed? Well, it's the knowledge that I produce utilizing the two different technologies. As I said, firms can use either one or the other, or both at the same time. We don't impose any restriction in that. And that's actually quite a nice thing because data is non-rival. So this is saying, if I analyze data for one purpose, it doesn't mean that I cannot also analyze it in a different way or for another purpose. Instead, dollars, once I spent them, I cannot utilize them for something else. So this is the knowledge I produce from data normalized to be, however much $1 worth of data I can produce. And so this is basically normalized to dollars, minus the cost of hiring the three types of labor, plus the present value of future captures, the Gordon growth type term. Now, from here, I can have three first order conditions, one for each of the parameters that regulate the three types of labor. And these are going to allow me to pin down those parameters, particularly this alpha and gamma is what I'm interested in. I'm going to need one additional condition that's going to allow me to pin down the data stock. So what is going to be the data stock? Well, the condition I showed you earlier can be rewritten in this manner if I start from accumulating from time 0. So if I know the initial stock at time 0 for each firm, initial stock of data, then I can move on and accumulate from there based on their data management hiring. Now, I don't know this term for all the firms in my sample, So what we are going to do, we are going to structurally estimate a DI0 and D0 average, an average value of the initial data stock across all firms in our setting. And then we're going to use a proportionality parameter to map that structurally estimated D0 to all the single firms. So what this condition says is that, well, data accumulates in this manner through my hiring of data management, but coming from the data first order condition in here, data also needs to satisfy this other condition, which basically says that the data stock must be optimal given the wages that I am paying to the different types of workers. With these four conditions, I can estimate structurally my four parameters, and these total factor productivities, I'm basically going to get them through either time series or cross-sectional averages. If you want to think about it in a simple way, essentially, those are time and firm fixed effects. So I'm going to absorb this time variation through this time fixed effects and this firm variation through these firm fixed effects, and the additional variation that's left in each point in time, that's what's going to pin down my parameters. So importantly, here I'm going to only use things that can observe. We don't need to observe K, we actually don't need it. We're leveraging the structure of the model to actually get to the parameters by just observing labor and wages. Now, how do we measure this? As I said, the objective here is really measurement. We build this model, we become agnostic as to whether there is indeed a large difference in productivity. And so we want to measure it using real world data. As I said, we focus on the investment management industry and we adopt a labor-based approach to measurement. It's one of the innovations of this paper. So what does that mean? Well, we start from the demand for labor. Importantly, our model takes stock of labor. I'll show you in a second how we go from demand to stock, but let's start from the demand. What we need to know is how many workers each firm is demanding for the three types: data management workers, all tech analysts, and AI analysts at each point in time, where time is going to be monthly for us. We're going to be using Burning Glass Technologies data for this purpose. We have the data from 2010 to 2018, and this data contains the vast majority of the jobs posted in the United States within that time period. And other researchers, Acemoglu and co-authors and so on, they have shown that the coverage is pretty good, and it's pretty good, is even better, particularly for the financial industry. We filter this data to identify firms that are predominantly investment management firms. We don't want this to be biased with, say, commercial banks and so on, where data might be utilized for different purposes and not follow exactly our flow. So we identify investment managers, and then within the jobs of these investment managers, we actually go to the full text of each job posting in order to identify jobs of these three categories. We adopted a dictionary-based approach in here because we wanted to have a lot of control as to what goes in each of these buckets, because imagine for the analysts, they might even have the same job title, quantitative researcher, but one might be a predominantly AI quant analyst and another might be just utilizing traditional techniques. And so this utilizing a dictionary-based approach and the full text gives us that additional control. So what we do in here, we identify the frequency of words of the three types in each job posting, and we classify the jobs based on the relative frequency approach. Now, these graphs show the word clouds of jobs that are categorized in the three groups. And in each of these word clouds, importantly, I have all the words belonging to all three of these groups, but you do see that there is a prevalence of words of one type. That means that even if, say, AI would be tangentially mentioned in some of the data management jobs, it would not be frequent. That would not be the case if these jobs were not easily distinguishable. Innovations in here is the investment management focus, and we develop a novel algorithm to identify and match through name matching the investment management firms. And indeed, the fact that we utilize the full job posting differently from most other papers that use this data, they utilize the structured data of Burning Glass. And this gives us additional control at the expense of more labor for us in order to do the categorization. These are some job examples. This is a quantitative analyst from 2 Sigma. Most of the skills that we see in here are all tech skills, and this job gets categorized in the all tech category for us. This gets categorized in the AI category. So it's, again, a quantitative researcher in machine learning. And these are the guys that are mostly utilizing developing 3D strategy using statistical and machine learning algorithms. And this is the data manager, SQL data analyst. Basically, they process the data, which then the analyst can utilize. Now, how do we go from demand of labor to stock of labor? We utilize Bureau of Labor Statistics data. Essentially, think about the stock of labor of AI type of firm I at time t as being whatever stock they have at time t-1 decreased by the separation rates, so how many people left the company, plus how many jobs are demanded, adjusted by a job type specific posting to converting to hiring rate. How do we get these rates? We get them from the Bureau of Labor Statistics, and we aggregate them across different job types by matching the job types that are present in the Burning Glass data set for the 3 job categories. So this is a cumulative process. As long as we have a starting point, we can accumulate it. Now, we don't have a starting point again, but what we can do in here is that we can utilize the data from 2010 till 2014 as a burning period. We use different initializations, and we show that by the time we get to 2015, these initializations tend to converge, and we tend to have some pretty accurate cumulative series, 2015 till 2018, which is going to be our estimation period. So this gives you an example, and this is the accumulation that starts from 0. We also started a steady state, which is actually, let me show you, which is the opposite point. Sorry, the slide should have been there, but no, which is the opposite point. So we started from steady state or from 0, and by the time 2015 comes, those series are going to look pretty much the same. This is AI. As you can see, in proportion to the rest, is still fewer jobs, but is the one that has the highest rate of increase. Salaries, that's the last point that we need for our estimation. So where do we get salaries? Getting salaries here is tricky. Even census data would not be good for us because we need stylists at the skill level. So even 2 jobs in the same location, in the same firm with the same job title might end up into different buckets for us if one utilizes predominantly all tech skills and one utilizes predominantly AI skills. And so what we do in here, we use pay scales salary data. This is a crowdsourced data set, is a survey-based system where essentially they tell people for free, if you answer some questions, we can build a very detailed report of where you place in relation to people that have similar jobs to you in your region with your same job title. And importantly, they ask people what are the 3 main skills that are required in your job. And so why would people do this? Because they're going to tell them, well, in your job and in your position, this skill that's best for you to learn is Python. People that have your profile but know Python earn $10,000 more a year on average. So people have an incentive to be truthful, as this data in the single firm is not shared. Then they aggregate this data and they sell it to the HR of firms so they can do better benchmarking of their salaries. So PayScale was generous enough to just give us their data. And so we are able to utilize a similar methodology as used for the job postings in order to identify jobs of the 3 types. And so what you see in here is that the AI labor earns about $20,000 more on average than the other 2 types of workers, but we have this salary by job type. Now we have everything we need. We have 4 equations for each firm for each month, the 3 equations from the first order condition and the data processing equation. These equations are only functions of observables. So we observe the data stock, we have measured it, we observe the salaries. So essentially, we're solving a complex system of equation for those 4 parameters that we need to measure. We use nonlinear least squares in order to solve this system of equations. We also use a grid search, as most of our parameters are bounded, with very similar results. So let me show you what these results are. Recall that what really captures this difference in productivity is the difference between the alpha and the gamma. In our main specification, with a depreciation rate of data of 3% per month, which is actually pretty large, we have a 5% difference. That is a drop in labor share from 18 to 13%. And note that the size of the drop is similar if I go down to a 10% depreciation rate, which means that every 10 months, my entire data set is worthless. So that's a very, very harsh depreciation rate. 5% seems to be a pretty accurate metric. And of course, that measure goes even higher if the depreciation rate drops, because if data depreciates slower, of course, the value of having these larger data sets increases and the productivity difference increases. Now, to put that into context, with all the caveats that this is just one industry for a short period of time, just to give you some sense of what 5% means, similar estimates for the Industrial Revolution were placed between 5 and 20%. So this is at the low end of the scale for similar measurements than, for instance, for the Industrial Revolution. So we think that this is a pretty large change. Now, this is structural estimation. It's true, we're just solving a complex system of equation, but we kind of want to know what is really pinning down this alpha and this gamma. Of course, it's structural, so all the different variables are contributing to this estimation. But what really matters here is actually the covariance between the data stock, how much data I have, and the relative payout to my analysis to data workers of the two types. This is just a simple transformation from my first order condition of data management workers. And we've actually rewritten in a very simple but intuitive way, because we can literally estimate this with a regression analysis. If you look at this beta 1 and beta 2, this is just the total payout to all tech workers, total payout to data managers, total payout to AI workers relative to total payout to data managers. And this beta 1 and beta 2, they're only functions of a bunch of parameter things that we know, interest rates, the delta, and the only other thing is this gamma and the alpha. So alpha and gamma are the only two things that differ in those two sensitivities. And those literally capture the sensitivity of the data stock to this relative payout. And what we see, just running a simple regression, is that indeed that sensitivity is higher for the data, for the AI labor than for the old tech labor. So it's really this covariation that I was talking about between data and productivity of analyzing data. That's what's driving this difference. If I have more data, I have an incentive to get analysts that can more productively analyze that data. And if I have those analysts, I have more of an incentive to get more data. And this covariation is what's really driving this difference in productivity. Now, this is just an observation from the data. It doesn't really come from the model, but we have measured these labor stocks. And so we can really think we have a drop in labor income share, but does that correspond to fewer workers or machine replacing our jobs? And what this is saying is that no, actually, the labor stock is going up in this entire period, and it's pretty evenly split between AI and old tech analysts. And so what this is saying is what I said at the beginning: the workers are getting a smaller share of the pie, but it's a smaller share of a larger pie. So they're not actually getting substituted. Now, of course, if I can do more with data, I have more of an incentive to collect data, I'm more productive at analyzing data, the value of that data is also going to go up. And this is a nice thing we can do with our model, because we have this value function. Once we have estimated everything in there, we can actually go back and through value function iteration, get the value of the data stock of each firm, and this is in the aggregate. And so you see that the value of this data increased by 39% in just those 4 years. Something else, and this is the final thing I want to show you, is that the productivity at analyzing data has also been going up, and particularly so for the AI technology. Now, this has a lot of caveats, because there can be a lot of things that are going on in here in the time series. These are those time varying total factor productivities. They're going to incorporate productivity of analyzing data, but also how many people are using it and so on. Think about it. I'm plotting the fixed effects in here. Now, to conclude, what we do in this paper is that we infer how much data each firm has by looking at how much they're investing in data management. And then we infer how much diminishing returns there are by asking what exponent would make the hiring patterns that we observe for these firms closer to optimal. the magnitude seems pretty relevant, particularly if compared to similar measurements for the Industrial Revolution. And we think that this is very important and it really matters for a lot of things like inequality, firm size, competition, and even more so because we think of this as a general purpose technology. And so repeating similar exercises in other industries and as a bit more time goes by, we think is going to be very important. Okay, thank you very much.
Thank you very much, Simona. Impeccable timing. The discussant will be Yiyao Wang from the Shanghai Shanghai Advanced Institute of Finance. Yiyao, nice to see you here.
Hi, Xiao. Nice to see you. Can you hear me, Xiao?
Yes, perfectly.
Okay. So let me pull on my slides. So I need to apologize first. I have to use my iPad, which means when I show my slides, my video just off. So that's just, yeah. So, yep. Can you see my slides?
Yep, we can see it.
All right. So I'm very happy to be invited to discuss this very interesting paper, The Changing Economics of Knowledge Production by Simona and Laura. So the big picture is the paper trying to answer the question, how does big data technology change knowledge production? But there's just huge economics behind knowledge production because it matters for total output, it matters for labor market structure, labor share of income, which is people find there's a declining labor share of income over time, which is also linked to inequality and other big economic topics. It's also related to economic questions like the role of data in production and also how to measure the value of data. So in that sense, this is really a very important big first order questions regarding the adoption of this big data technology. But the challenge of this line of research is data stock that a firm or a country owns, and also the productivity of data is not directly observable. And if you want to measure, it's very hard to measure. Okay, so this paper take up this challenge by applying the classic Cobb-Douglas production function. It uses data and the labor as an input to produce knowledge. So knowledge is as an output. So in this framework, they introduced two types of knowledge producing labors, so-called old technology labor and this AI labors. Okay, so the key parameter the paper want to get out is the labor share of income in these two production functions. We want to see how the old technology production of knowledge and the new technology that produces knowledge, how do they differ in their production in the labor share of income and also the data share of income, how these two production function looks differently. The paper laid down such a model and it get data, labor quantity data from mainly from burning glass job posting data. Of course, it supplement with a vacancy rate and all these other data from BIS. On the wage side, it uses the pay scale service data to back out the labor wage. Okay, back out the labor wage. But what I think is really quite important and creative is the model, both in the model and the data. The paper introduces so-called data managers who process the data. Okay, so they actually in the model you have three labors, two types of knowledge producing labor, and then you have data managers who process the data. And that's very important for the measurement because according to the model, the wage and the quantity of data manager, this type of labor, actually help structurally estimate the stock of data because they are the ones who are producing the data. I mean, actually they're acquiring data, process the data, and structuralize the data. But they are, for the firm, they are producing the data, and their wage and the quantity actually represent how productive they are in the model in terms of producing data. So that's why acquiring their labor information going to help you back out the stock of the data the firm has. So I think that's a very creative way of getting out measurement for a stock of data for a firm. This is not only for this, so this is not only a, a good method for this paper, but this methodology of getting out the value, the stock of a data for a firm or for an entity, I think is quite, can be applied to other settings as well. So the contribution first, of course, is the economic question. It's a very important questions that need to be answered. So the paper provide the paper did a lot in estimating this labor share of income of this different production technologies. And it finds that the labor share of income in producing knowledge is 5% lower when you have this big data or AI technologies. And this number is comparable to thinking about industrial, in the historical period of how we enter into industrializations. Okay, so that's I think if we don't have a number, and this paper provides us a number, and it's actually carefully designed, it's based on very classic economic models and with a very careful treatment of how to measure things. So I think that's a very as a first answer to this question, that's a very, I think, a very well thought and a convincing number to be your prior for this answer, for this question. Another contribution, I think, is really, it's a very elegant and valuable methodology to structurally estimate models, not only models within this literature, but also any models with data in the production function. So it's kind of methodological wise, I think it's making a big step forward. So three major comments. First, the paper focused on the investment management industry because they are the early adopters of these big data technology, and also the labor classifications, I think arguably it's cleaner when you look at these industries. But a potential concerns in this paper, the knowledge production to real production is assumed to be linear. So so knowledge are measured as units of dollars. So there are several potential problems. First is in the investment management industry, there may be a strategic considerations. In the extreme case, if all investor has more investment knowledge, then their relative performance should not change, because when you're adding up, they're earning the market rate, right? So in that sense, there's a strategic elements to knowledge production in this specific industry. Investors are competing with each other to some extent. So I think we may need some firm level performance variables sort of to cross-validate. For instance, for investment management industry, at least if you can get some fund flow information or other performance variables to cross-validate, knowledge production is really convert into real production or real profit. I think that adds more confidence to the model. Otherwise, you can, of course, apply this methodology to other industries. If you have listed firms, then you can look at their financial performance. And there are other industries when you can acquire patent data. So that serves as the outcome variable that maybe help, that gets you more variables to cross-validate or to estimate, structurally estimate the model. The second comments is really about an inflation consideration, because in the model, it's a real model. So it's sort of saying that knowledge, the value of knowledge kind of stay the same. And if you write a nominal model, that just means the knowledge, the value of knowledge inflate at the same speed as the price level. But in reality, maybe the value of knowledge could inflate faster due to the higher technology adoption. So the challenge there is, can we find a way to deflate the value of knowledge using some data? So that's, I think, would help strengthen the arguments from the model. So comment number 2 is about the results quite sensitive to the assumption about the depreciation rate of data. And it seems to be more sensitive when depreciation rate is small. When there's 1%, then the change in labor shares is as large as 23%. Directionally, that's okay, but magnitude-wise, that may introduce a little bit of concern. So we dig deep into the depreciation rate. What drives that economically? Well, that's just, to me, that's the relevance of past data. And I think that's quite firm specific. For instance, if you are a firm who basically use earning informations to make investment, then past information is gonna depreciate fast. But if you are an algo trading or high frequency trading company, then past data may be still quite useful, not very useful as recent data, but still quite useful for training the model. So in that sense, maybe we can try to extract more information about a firm's depreciation rate depending on what jobs it's looking for. So if you have confidence that the firms is hiring someone who do earning analysis, then maybe those are firms who you want to put into a higher depreciation rate. So that's kind of getting into, I think it will be helpful getting into this variation of depreciation rate depending on firm business features. The last comment is about thinking about AI labors. In the model, they supply labors to produce knowledge with data, and then they get a wage period by period. But I'm a little bit concerned, maybe in reality, these workers probably own or develop the model. So it's as if the AI labor is more than a simple production input, but it may be also important for shaping the production function of knowledge. So that's a little bit like entrepreneurship type of argument. They are not simple labor. They are also the ones who, without them, you don't even know how to produce. So in that sense, that's gonna introduce this measurement problem, because if you take that view, then the total compensation to AI labors may be larger than the marginal per product of AI labors when you in the model, because in the model, that's just the input, marginal productivity of the input. But if the production function cannot be run without one AI labor, then his contribution arguably is larger than what you can measure from the data marginal product of the labor. So in that sense, I think there's several ways possibly you can address this concern. Maybe you extend the model to take this into account, or maybe you can just look at the low skill, in some sense, AI labors, depending on more cleaner or detailed classification of labor jobs. Because low-skilled AI labors, arguably they are supplying labor, more like supplying laborers. But if you have high-skilled AI laborers, those guys are more likely to also develop a certain trading strategy or in general models. So in that case, the wage measurements may be more contaminated. Okay, so overall, I think it's a very interesting paper. It answers very important questions. I think, and also, although Simona present the paper very well in the 30 minutes, but trust me, the paper has much more details and information that's worth reading. So I recommend everybody read the papers. Thank you very much.
Thank you very much, Yiyao. Yep. Let's do about a 3-minute discussion. Simona, do you want to respond? I think there also might be a question in the chat box.
Yeah. I'll just give a super quick response. Thank you so much, Yiyao, for the great discussion. On your first point, we completely agree. How much translates to $1 worth of knowledge has been changing over time, and there is a bunch of other stuff that's changing, including how many people are using it. If a lot of people are using it, maybe I need to do way more of it to get to that $1 worth of knowledge. And so that's why we think it's really, really important to get that time varying fixed effect, because that's going to be absorbing a lot of this variation. So if the mapping between knowledge and data plus labor is changing over time, it means that that scaling factor is also changing over time. And so having something that over time can take care of that is super important. And that's one of the reasons why I said, I'm just plotting the fixed effect, but a lot of stuff can be in there and we cannot separate from all of those, but it's important to have it in there. Yeah. And on the depreciation rate, we gave this a lot of thought. We also started thinking about it in the same way as you, that the depreciation rate is the depreciation rate of the data type itself, but actually in the model, that's the depreciation rate of the data management workers, at the labor of the data management workers. So it's basically how fast does they depreciate the time that they can do to code up something and add the data stream to the data set and so on. And so in a way, that's more closer to the depreciation rate of software, which we actually took from accounting and translated it to that 3%. So that's where that comes from. And finally, when we think about analysis, it's definitely also thinking about what model to do, and the old tech, they're going to think about which regression to run and what to put in there and how to structure it. So analysis includes all of that. The point is just, if I'm using the old tech analysis or the new analysis, I have different tools in my toolbox, and having those different tools in your toolbox might determine a different productivity. So what we're thinking is that the financial analyst is not redeveloping a new neural net algorithm. They're taking some neural nets from computer science, and then definitely they're developing their own models, but the toolbox they're drawing from is different.
Okay, thanks. There may be some question in the chat room. Maybe you want to respond a bit.
Yeah, I think Will has a question, and then there is something in the chat. Yes, so in the chat there was a question about Wyckoff Douglas. So we thought quite a bit about Wyckoff Douglas and not CIS production functions. It's not quite obvious to us that CIS would fit better, but the main reason why using Cobb Douglas is because we need to use lever a lot on the structure of the model in order to estimate things that, as Yiyao said, we cannot observe, like knowledge, like data. And the fact that Cobb Douglas translates so easily into labor shares is something that we actually lever on, and we think that there's no obvious reason why CS should fit better, but there is a pretty good reason why for our structural estimation it actually makes it much more tractable, and so that's why we went there. And also for comparison with Industrial Revolution, whereby most of this simpler analysis is done in a similar fashion. LinkedIn data, we don't have access to LinkedIn data. There is my colleague, Tanya, they use Cognizant. There is CV level data to match it to Burning Glass, and they found some pretty good mapping between those two. So, in the aggregate, we think we're doing a pretty good job. Of course, there's going to be some stuff at the margin that we cannot capture, but at least we don't think that this is biasing our results too much.
Yeah, Simona, can I answer?
Yes.
Yeah, great presentation. Always learning a lot from your work. So I know in the paper you say you accommodate the non-rival nature of data by allowing firms, any firm to use the data. I'm just thinking the marginal contribution of data. For example, if there's a non-rivalry in the horizontal sense, right? Competitors also using the data, that could reduce the value one gets from the data if we model the demand side. But if it's vertical kind of non-rivalry, my upstream, downstream suppliers, they are familiar with, we have some common language that could help actually increase the marginal contribution. Is that something that is feasible to incorporate in the framework, or is tractability-wise it gets too?
Yeah, so that's a great question. In here, we only allow non-rivalry of data within firm. Now, there are two things. One is, like Yao was saying as well, as more firms are using this stuff, more firms are gathering data, it might become more and more difficult because of competition for firms to actually draw value from this. And so we really think that that time varying parameter will be capturing some of that. And the fact that we use this reveal preference approach at the firm level is going to be capturing some of that. And so we do see a lot of dispersion where a few firms are emerging as being these like massive data centers and investing the most in AI. And then we have some that don't do at all. And because we have this reveal preference approach, we think that some of that is going to be driven also by competition. And that's a time varying thing, which is captured by that parameter. That being said, if we were thinking particularly about other industries, we might think that data trade could play a role. And then if we want to introduce data trade, and firms can get a revenue from trading part of their data, but if they do so, they might advantage some of their competitors, and that could enter back into a general equilibrium consideration that we don't have in here. Actually, I've been working on something separate that introduces a flavor of that concept. but we think it's less relevant for finance because you wouldn't think about, I don't know, Renaissance selling data to JP Morgan and so on, because there is this, the concept of proprietary data and not wanting to share precisely for those competition reasons. We think it's less relevant in this setting, but definitely non-rivalry extends beyond the boundary of the firm, and that's something that we've been given some thought to.
Thanks.